finish the chapter 11 handout. We'll see, but and we may finish the monetary unit sampling. Hopefully we can get those two done. Okay, so let's so chapter 11. Okay. All right, let's take a look at this. Relevant assertions. All right, relative assertions. Relevant assertions. These are I don't know if we talked about this before. I think we did. These are the assertions that are made by management when they give you the financial statements. That the presentation is correct, the disclosures are correct, that there was something, existence, for instance, for assets, that there's an existence or occurrence, something like, for sales or something like that. Rights and obligations. Rights and obligations are that you actually own what they are. Completeness and cutoff. Cutoff is new, so that one I would say was more likely to be tested. And valuation, allocation, and accuracy. Accuracy is per transaction. It's not for the financial statements as a whole. So this accuracy is a little bit of a funny one too, in that we never say the financial statements are accurate. For one thing, we don't test to that level. So we never say the financial statements are accurate. Even if we don't find any errors, we're taking samples. So there definitely could be errors. We never say that the financial statements are accurate. But the accuracy assertion means is that when you look at a transaction, that there is the assertion that that transaction, each transaction you look at, there is the assertion that it's accurate. And if it's not accurate, that can be a problem. Okay. Which assertions are aided by the accounts receivable confirmations? Which ones are going to be most likely aided?
Is it D?
B is the best one. It will tell you if there's an existence of the accounts receivable. Now you might say, well, what about valuation? They send it back and they say, well, whether it's good or bad or whatever. There's two problems with valuations. First thing is, if you leave an account, if you leave an invoice, say off of a, go back. If you send out a confirmation and you leave an invoice off of it, maybe there's another invoice that should have been on this. Now, hopefully your customers are very honest and they'll tell you, hey, I owe you $10,000 more, or whatever it is. But it's possible that whatever's on here isn't the total. And that, that the client, whatever, is not, I should say the customer or the client is not being totally truthful and not, not an ethics class, but so the valuation can be a little bit tricky because of that. If they're negative confirmations, you really don't know, because you don't know if the confirmation even got to the right people, or if it was or if the people got it and ignored it. Positive confirmations, you get all of them back, but so another thing is that a lot of, you could have a positive confirmation, get back, and the people say, yep, that's exactly what we owe. By the way, you're never going to see it because we're going bankrupt. So the valuation of that one, even though you go through the diligence and you say, okay, this, yeah, this is everything we owe, and you're not going to see a dime of it. So it doesn't really help as much with the valuation as people might think, at least on the surface, because there might be things left off of it. They may not have returned it, if it's a negative one anyways. And there's also the possibility that even though they do confirm it, that they won't be able to pay it, or they're not going to pay it, or whatever. You run into all sorts of people. So the best one though is this, that it exists. Which assertions are aided by the sales cutoff procedures?
B.
Could be, yep. He's not a
No, I said D.
Oh, D. D is probably the best one because yeah, it's included in there. It used to be, it used to be in down here in the valuation stuff. They used to have it, but now cutoff is by itself. So yeah. But it does go to the occurrence of a sale too, though, because cutoff procedure will say whether the sale occurred in the current year or in the following year. So it does actually help with occurrence also. Obviously, the best one though is the one that says cutoff on it. Which of the following accounts receivable assertions are aided by analyzing the bank cutoff statement? So we get that cutoff statement, and we verify the stuff on the bank reconciliation. We verify possible payouts for loans and things like that that are done at the end of the year that weren't on the books. I tell you what, let's just focus on the bank reconciliation. So let's say the cutoff bank statement, we're using it to verify the bank reconciliation.
Would that be E? Valuation, allocation, accuracy?
Yeah. Yeah, and part of the reason why we would look at that would be, especially with things like sales and that at the end of the year, that whether they were real sales coming in, and then if they were real sales, then the accounts receivable you would expect to be paid fairly soon afterwards. So it's kind of looking at these accounts receivable too, as far as the collections are concerned. Okay. Oh, this is a good one. Are accounts receivable confirmations required by generally accepted auditing standards? Yes. Unless you have a really good reason. So yes, unless you have a really good reason. What would be a really good reason? If they are immaterial. And obviously immaterial. If you have hardly any or none, then you don't have to. It's also possible too that possibly you have one account that is just huge compared to the others. When I worked for Navistar, we used to make, I don't know if they still make them or not. They used to make diesel engines for Ford, and they made them. There's a plant in Indianapolis that made them. And literally Ford would take something like 95% of our production. We had one customer. So basically, when you came in, you audited that, you're going to basically be auditing the Ford account. That's going to be it. You know, those other accounts, which were made up of small, you know, like boat manufacturers and things like that. Some of them for generators and some other things, but a vast majority of our production were in that. So that the others were by themselves, all of them obviously immaterial, because they were nowhere near the dollar amount of the Ford. And even if they were all misstated, it wouldn't make too much of a difference. So if they're immaterial, you done. But generally speaking, though, you are required to do it. Are they required by international standards? No. The international standards, they do recognize them as a valid procedure. Spelling things wrong. The international standards do not require them. So US standards require them, international standards don't. And we find this a lot with the international standards, that they give a little more judgment to the auditors, whereas US standards are a little more prescriptive, that they say, you know, you're required to use it unless you have a really good reason not to. Whereas international standards say no, however, you know, they kind of leave it up to the auditor's judgment. And there's pluses and minuses both. So it's kind of like, you know, it's kind of like we were going to drive from here to, you know, wherever. We're going to drive from here to Minneapolis. You know, there are different ways to go there. As long as you get there, you know, and that's kind of like the international standards. The international standards are like, hey, however you get to Minneapolis, that's how you get, you know, that's fine. US standards are more like, you get on this road, you turn here, you get down this road, you know, they tell you exactly how to get to Minneapolis. And so, and there's pluses and minuses to both of them. But anyway. Okay, who should be authorized to write off accounts receivable? This is actually somewhat funny, but anyone except Treasury or accounting, and in particular the accounts receivable clerk. And you say, well, why is that? Well, Treasury, they have control of the assets, the cash. So you don't want to have them also control of authorization. Accounting, I should write this in somewhere. So Treasury, they have the assets, the cash. And accounts receivable, we have the bookkeeping. So the authorization should be done by somebody other than those two groups. Somebody generally unrelated to those two groups should be in charge of writing off accounts receivable. Because notice, I mean, if that could happen, then you could have all kinds of things happen with the books, that they would have the authorization as well as bookkeeping, or as well as the cash. You could have a treasury department write a check to themselves, or keep the check, I should say, or whatever that comes in, and then write off the account, just put the money in their pocket. So, okay, this last one, what's going on here? Oh, no, we got a bunch of, look at all this stuff. What idiot made this up? All right. One of the things that we have to do, and this is in all auditing, whenever there's an exception made to anything, we do what we call clearing. You have to clear these exceptions. So if you're doing a test, and you have these things that you find that are wrong, you'll have steps to do to clear those. And by the way, I think I mentioned this, maybe I did, but when you're doing an audit, all the stuff that I'm talking about here, this is generally included in an audit, the audit plan or the audit program. You're not going to be reinventing the wheel. And you can actually pull these up online. You'll see audits for accounts receivable, audits for cash. You'll have to tailor them for whatever you're doing. But anyway, so all the stuff that we're talking about, I don't think when you walk into the job, you have to know, oh, these are the 15 things we do to audit accounts receivable, something like that. It's not true. They will have some kind of an audit program, and nowadays you can search around on the internet and find something appropriate. But we have to clear up whenever there's an exception. And one of those things is for the accounts receivable. Accounts receivable, you're dealing with a client, their customers. So if this is IBM's customers. Customers are part of the public, and they can be wacky, they can be absolutely honest, they can be absolutely dishonest, they can be all kinds of things. So whenever you get a return on these confirmations that there's an exception to it, you have to clear it. And so that's what we're going to talk about. Okay. Audit steps to clear accounts receivable confirmation responses as of 12/31. Number one, we never received the last shipment listed. How would you clear that? So you want to see if they actually, if that was actually a real shipment. How would you do it? I'll give you a clue. It's up here in our documents. Actually, it's here. What would you do?
When do we have to review the bill of lading?
Yeah, bill of lading and possibly proof of delivery. It depends on what this is and how long it was. But one of the ways you want to see, okay, because here's your concern. You're concerned that it was not a real sale, or that they never shipped it and they counted it as being shipped. So the most important is the bill of lading, because that will show that they actually put it on the truck. It may not have gotten there, but it shows that the client did their part. They put it on the truck. Second, important, or I don't know, let's say less important, is the proof of delivery. And the reason why that's less important, here, let me highlight those. So the most important is going to be the bill of lading. That shows evidence that the item was shipped. Or it could show evidence that it wasn't shipped. Proof of delivery is less important. It even if it wasn't delivered, you know, you say, okay, well, if it wasn't delivered, then it's not a sale, and that is true, but they're probably going to have a claim with the insurance company and whatever. So less important is going to be the proof of delivery. You might still look at it to see maybe it was. Sometimes people say they didn't receive it, and you know they did. But the most important here is going to be the bill of lading, and you'll find that with a lot of these, because the bill of lading shows evidence of something being completed, and it'll have exactly what was shipped on it. It won't have the dollar amounts, but I'll say what was shipped. Okay, number two. Two's one that's a little more difficult. About 3,500 of this invoice had been returned on 12/9/23. All right, this is probably not as obvious because I don't think we've talked about it. I know we haven't talked about it.
Usually don't people issue like RMAs and stuff like that?
Yeah. Return material authorizations, but these also go hand in hand with receiving reports. And I'll talk about that in a second. So RMAs, return material authorizations. You guys are sure familiar with those. But but also receiving reports. And here's why. When something comes into a place, they don't just take it in. There's usually a reason why it has to be there. So there's going to have to be, if for instance, if a supplier ships something, there better be a purchase order for it. If there's no purchase order for it, they turn the truck around and tell it to leave. I was actually on the docks one time when that happened. A truck came in that was making a delivery. There was no purchase order assigned to it, and you know they said, well, we can't take it. You know, because we have to the shipment, we have to load it in based on a purchase order, and there's a receiving report that goes along with it, but there's no purchase order or receiving report, so they turn it around. RMAs say, okay, something's coming back from this person, so when this comes in, you're going to match it up with that RMA, return material authorization, and they will take it back in if there's an RMA. If there's no RMA, it goes back to the sender. So that's what kind of on an RMA, they kind of go hand in hand with the receiving report. So from the documents, you're going to see if there's a receiving report for it. And if there is a receiving report, then you may have a problem because, why this was returned on the 9th. It probably should have hit the books before the 31st. So this is going to be a receiving report, and a lot of times there will be an RMA that goes along with it. This one's a little bit funny. I don't mean like haha funny, but I already paid this on 1/26. The check number this is the check number. What's odd about this date?
It's after the cutoff.
Yeah.
So it would be an payment in transit at the time of the confirmation that's being requested.
Yeah, and this is proof that the account did exist. They paid it. We already paid this on 1/6/2024. So yeah, the confirmation obviously went out after that, but on 12/31/23, they must have owed it because they paid it on the 6th. So while this looks like it's an exception, this is actually, in a lot of ways, not an exception. It's a confirmation. They're telling you, yeah, we already paid it. Now, you might still look and you might look to see if they actually got the check. The check would be on the, you might check the checklist, slash deposit slip. But this is, at least on the surface, this is an acknowledgement that they did owe it on this date. You know, and it is a confirmation. Again, you might check this to make sure that they actually did, you know, send it in, and that this is not just something they made up. But if you do go to the checklist of the deposit slip and you see it on there, yeah, it's a confirmation. Number 4, not our order. The entire order from 12/12 was returned on 12/15. This was another customer's order. Your company is stupid. Okay, well, what do we do with this one? It's actually similar to another one.
You can check the bill of lading again.
Well, they actually shipped it. They look like they got it. They had the order from 12/12, so it was returned on 12/15. So it's probably gonna be similar to this one. I mean, the problem was that they shipped it to the wrong people. Now you could see, I guess, you know, where did they ship it to? I think that's probably what you're talking about. Yeah, I would check. Yeah, check the bill of lading for the address. Oops, that's nice. Spell check. But yeah, but then see if it was returned, and see if it was actually shipped out to whoever was supposed to get it. You know, this one might take a little bit of legwork to see what it is, because they may have just had it, you know, shipped to whoever the correct order was and put that on the books and never took this off the books or whatever. And by the way, it's stuff like this. If you're wondering what happens on audits, why they take so long, it's this kind of stuff. You know, when you're going through the normal, if you send out like 100 confirmations, those 100 confirmations take seconds. I mean, you know, let's say 20 minutes to send them out. You know, get them ready and print it out and send out. It's getting back and doing this stuff where you're making phone calls, you're trying to figure out what happened to it, you're talking to people, you get 3 different stories, you're trying to, you know, this is the kind of stuff that just drives you nuts because it takes so long. Okay. This total seems too high. And yes, you have to clear it. What do you probably look for on this one?
Wouldn't that be like a mix of receiving report and shipping and
You'd probably look at the shipping first. It doesn't look like it, well, unless you don't know, but if they return something or not, it doesn't really say there. But certainly the bill of lading would be something that you'd look at, see if they have.
You're probably looking at the shipping, the freight, or something like that.
Yeah.
Freight costs.
yeah, because I know like with us, like there's times that they'll say, oh, you're getting 3,000 pieces, but we really got like 3,500.
Oh yeah, definitely. And yeah, and that's why you have the receiving reports. You know, the receiving report will say what was actually received, and then those should be matched up to the invoice. I don't think I should have talked about that. That's with the accounts payable stuff. But yeah, so a receiving report is usually is the same thing as a purchase order, except it's left blank, the quantity. The quantity is left blank so that people count them. And yeah, you count 2,500 and they bill you for 3,000. And one of the things that if you have vendors complaining a lot of times is because their invoice does not match up with the receiving report. They say, okay, well, you shorted us 500 of these, so we can't pay it until you send us an invoice that shows that it was insane. There are some companies that will actually just correct the invoice. They don't even bother, contacting the other company. I was at an audit one time where there was literally a vendor that shorted everything, and was always surprised by it being shorted. And it was a weird thing. It was up in Minnesota. It was actually at a mining operation up in Minnesota, and there was no one else in the area that supplied the same stuff, so they had to deal with this person. But they would literally short every single order, and so every single invoice would have, the payment would have to be changed on.
You can also check the invoice to make sure there's the correct unit price and extension for what was put on the bill of lading and packing slips.
That's true too. Invoice price and the packing slips, and if they have it, you can also compare those to the customer's purchase order. Usually the purchase order will have the prices on it. So when a customer, if they do use purchase orders, the purchase order will have the price on it, and that should match up to the invoice. And if it doesn't, then there's a problem with the the sales and the purchasing department of the customer. So if it's especially if this is business to business, the purchase order price should match up to the invoice, and the packing slip should match up to the purchase order. So the price on the invoice, the number on the packing slip, those should match up to the customer's purchase order. Yep. Okay. For 6. For company policy, we cannot disclose any private information regarding our vendors. Yeah, this is one of those companies that's run by lawyers. So what do you do with that?
They're not disclosing anything that the auditors don't already have access to information.
Yeah, so you're probably back to this.
It's really not private information that they're dealing with.
No. But you're probably going to say, okay, well, let's check the the bill of lading, see if they actually sent this material and what when they sent it, and back into the numbers that way. Bill of lading, you're going to also need the sales invoice, or if they have it a purchase order, but and then to back into it to see what the prices are. Again, this is all stuff that takes time. If you're wondering why some of these audits are frustratingly long, it's tying up these ends. Okay, number 7. We picked this order up at will call. Talk about that in a second. And paid cash. We don't know anything. A copy of the cash receipt was included in the return envelope. Okay, so will call. You want to know what that is?
Picked up.
When you pick,
What is it?
it's when you pick up something from a vendor, like at the warehouse instead of it being shipped.
Exactly. Usually it's for local stuff. There's a place that sells stuff all over the country, but they're located right by. You say, okay, well, can I send a guy over with a truck to pick it up, rather than you having it shipped by somebody 10 blocks to our business. So yeah, will call is when somebody's local and they make a purchase and they don't want it shipped. They'll send somebody there, to pick it up. And they have a will call office, and there's usually the, whatever the order was, they'll be sitting in. It's kind of like what they do with the stores now, order stuff like, it's at least back when COVID was going on, you order stuff ahead of time, we'll pick it up. Same thing. So the problem here is they paid cash, and apparently they have a cash receipt. They apparently sent it. So of course, check to see if that cash receipt is the right one and for the right business and all that kind of stuff. But given if it is, what's the problem here?
They returned it.
Well, if they returned it, they should get their cash back. I mean, it's could be they returned it, I guess. That would definitely take the, they picked it up and go, wait a minute, this isn't right, and they take it back and get their cash back. Could be. They did have a receipt though. The problem with this is, if this did happen, what happened to the cash? Because did it actually get deposited and it was just a clerical error, or was it it disappeared? And it was never deposited. So I guess the question was, and that might it brings up a it brings up a control problem. That notice that this was not something that was detected by the client. They may have a problem with cash collections at the will call. So this could also be an internal control problem. That the client may not even have known about. So was the cash actually deposited? Did they, again, it could possibly be that it was a cash sale. They, whatever reason, they mistakenly put it in as maybe someone didn't know what they were doing, put it in as a sale on account or something. But it also could be that the cash was missing. This was an intentional thing, and there's actually an internal control problem. All right. Any question on those? So again, you got to clear this stuff up, and this is the kind of stuff that really is just frustrating sometimes when you're doing auditing. Okay, let's go to, I think there's 2 pages of these. And what this is, so information from the sales journal. Okay. By the way, one of the many companies, the craziest group you're ever going to meet are the salespeople. They think way different than we think. If we put in controls on what customers can purchase or whatever, the sales department, the first thing they start doing is looking at ways around it. Oh, well, so if we do this, and if I ship this to this other person, but then their whole, when you put rules in front of them, their whole mindset goes into how do we get around these rules. I found that to be very common in the places that I worked anyways. And so a lot of times things like sales journals sometimes are may warrant a little more focus than you would normally think. And a lot of times they get paid commissions on sales and things like that. I mean, there's incentives for them. Okay, so here is what they have for the information for the sales journal. And notice that the sales journal, this is going down through the 31st, and then this goes into the 1st. So these are going to be the amounts that are going to be in 2022. Okay. Now, going down here to the bills of lading. These are the ones that should be, yeah, let's make those green about. In 12/31/20. So you go to the bill of lading, down the shipping department, they go down to here, this is the cutoff. This is the last item shipped. Okay, so coming up here. I'm gonna scrunch these up to get them both on the same page. All right, so let's see which ones of these were actually sold. So 3782. 3782 was sold. 3783. 3784. And 3785. All right, so these are the actual sales. Well, what we need to do is figure out the totals for these. All right, I'm just gonna do it on the side here. So let's see here. We have 3782 was for $700. Let's write it in. 3783 was 800. 3784. Wait a minute.
1,200.
Yeah, I'm sorry. And 3785 is 400. Okay, so the total of those is something.
207. 31.
Yep. So this is what their sales should have been. Now, what did they have here? So this is what they counted as their sales. $48. 20. I think it's 4,800. You may want to check me on that. Is that what you guys got?
Yeah.
Oh, I get worried when I hear silence. Everyone's too polite. We didn't get exactly that. We got the right number. All right, so this is what so which invoices? Oh, guess I got a little.
I got 3,100. Yeah, that's right. Okay.
Answer my own question here. We gonna do all this stuff. So these are the invoices they should have had. And yeah, those add up to 3,100 here. Okay. Should have just done it here. They're doing it twice. If all the 2022 invoices are included, what correction would be necessary at year end? Okay, so this is what they booked, 4,800. They should have booked 3,100 for the same. So what's going to be what's the difference there? 17? Yeah, 1,700, right? So correction, and this would reduce the sales. Let's say this for accounts receivable too. Sales journal, something is for, so it looked like this. Sales would go down.
Professor, how did you get the 4,800?
I added what they had counted from the 31st for the this is what the sales department counted. So they counted these 4. And these were not in the period, according to their records. So this is what they had for these invoices. They had 4,800, recorded on their books as happening before year end. The problem is this 2,100 didn't ship yet. It didn't ship until the 1st. So this one doesn't count. Basically what happens is we're actually losing this 2,100 and picking up this 400. I mean, that's basically the difference between them. That's a $1,700 difference. But yeah, so this is the sales journal. So the sales journal, they recorded 4,800. They should have only included 3,100. And so the difference between those. So this is a sales journal. And these are the bills of lading. Let's highlight that. So the bills of lading are really what you go by there, and they didn't ship the 2,100 order until the next year. So this one really didn't count, but this one did count. 400. And so that's a correction. If you were to make a correction on this, you'd have sales revenues unusually going down. Usually sales are always credits for 1,700. You would have accounts receivable going down. Oops, no, that's right. By 1,700. You may also very well, and we don't know what the dollar value is, but so if these are goods, you may very well have a journal entry for the goods. And I use a lot of space here. needlessly. Okay, so you could also have, now I don't know what the numbers are gonna be here, but you could also have stuff going back into inventory because it actually wasn't sold at year end. Don't know what those would be. Oops. And our cost of goods sold be going down by some amount. Again, don't know what that is. But yeah. So this would be sort of, this would reverse out the sale of the accounts receivable. This would put those things from that 2,100 that were not sold. And then also there'd have to be some adjustment for the inventory that was sold on that $400 order. I would have to think that the inventory sold would have a value less than the 2,100 order, but anyway. Excuse me. So, putting inventory back in, this was the unsold inventory of the 2,100 minus whatever sold on the 400 one.
Professor, you may also have an entry to adjust earned commissions and in the payroll if
Absolutely. Yep. That's not, yeah, excellent. Let's put that in. That's an excellent, and that may be why they did it. Yeah, because they could be very well that they. One of the things that they always talk about, holding the books open. That they'll hold the books open and make sales going into the next year, but record them in the current year. Yeah. So this one could very well, even though you look at this, say, well, wait a minute, they it looks like they made the sale at that. Look at the invoice and all that. Yeah, they very well could manipulate that to come out like that. Someone's working on a sale that doesn't get made till the next year or something like that. They could do that. Salespeople are really different. They're really different than most people. All right. This is a similar one. Just more back. You will have one of these on the test, so it's. See if you can figure this one out. And again, the real thing that we go about here is the bill of lading. These are the things that we really focus on because this is what actually went out the door, and we know when it went out the door. There's a third party signing off on it. There's a shipping company. So our sales general was 24. My God, it is on 2,400. Bills of lading was 2,800. So the sales should have been higher on this one. Or a negative $400 correction. So I guess negative is kind of funny looking on that. Now let's switch these two around. So it's $400 correction, and now this is going to be just the opposite of what we just did. It'll be the opposite of here. We're going to have to reduce. Scratch that. We're going to have to increase the sales and accounts receivable, and probably the cost of goods sold, and possibly pay out more for commissions in the payroll. Because this time the sales were a little higher than what they had first reported. So anyway, you're gonna get one of those on the test. What should the correction be on? My father-in-law was a sales rep for an automotive supply company. In his garage, it looked like an electronics shop because they had iPads and all this stuff, and I was like, well, so what do you do with all of it? Well, we give it away. You know? Like, well, so who controls, you know, how do they know you're not taking it? They don't know. Because, you know, if there's a problem with an account, maybe you have like a $6 million account that there's a problem with, some guy gets all mad and somebody, you know, so you go in with a couple of iPads, hey, I got a couple of iPads for your daughters, and you know, they go, oh, okay, and then all of a sudden everything's smoothed over for, you know, whatever, $1,200, you just saved a $6 million account. But, you know, it was kind of funny though, because there's like all this stuff in there, but, you know, when the problem happened, like, you know, he was right on it, like, okay, we can go in and smooth it over. All right, let's go ahead and take a break, and then we'll come back. We'll go into, we're done with this, right? Okay. When we come back, we'll go into the monetary unit sampling. And we'll do some of the stuff, a little bit more of the stuff from chapter 11 next week. So monetary unit sampling, I got to. Oh, here we go. Okay. Be back at what time is it? 7:01, say 7:11. Oops. Okay, monetary unit sampling. Well, you recall from last time I was telling you how great monetary unit sampling is. And now I'm gonna tell you some of the sort of irritating rules about it. Let me do something here. Oh, that worked out better than I thought. Okay,
Professor, that handout is not in our notes.
it's not.
Mm-mm.
You should have it from last week.
Um,
No? Hold on a second. Let me see.
oh, yes, it is. Yes, it is. It's so small on our paper. Okay, sorry.
Yeah. Yeah, let me get rid of some of this stuff. Okay. Yeah, so there we have the rules for monetary unit sampling that they make it a little less fun, we'll put it that way. Okay, so let's see here. Incremental allowance. And we'll talk, I'll give examples of this in a little bit. Incremental allowance. Incremental allowance is really is as simple as this, but it comes about more complex when we start doing the actual crunching of numbers. But it basically is this. If you do find errors, then that shows that there could be more errors possible. So whenever you have an error, it increases the amount of possible errors in your sample. You know, if you find $1,000 worth of errors, that tells you that there could be more errors than that in the sample. So the more errors you find, you know, the greater the possibility that your sample could be off. So that's kind of the basic idea of it, which is one of the reasons why if you have a whole bunch of errors, we'll find out later that this kind of sampling is not the kind to use. If you have a whole bunch of errors, you're going to get such a large distribution that it's not going to be as usable. But generally speaking, probably proportional size is used for things that have a smaller number of errors. But any error that you find increases the likelihood that there'll be more errors. Okay. We talked about this a little bit already. This method is used for overstatements. If we find understatements, we don't do anything with them. So if we find understatements, we ignore them, which as an auditor kind of rubs you the wrong way. You find something that's not correct, you go, okay, I want to write this down. I want to show people that this, and look what I found. I found that this thing is understated. This method doesn't look for understatements. Understatements are ignored. So that's a quirk of this method. Okay. And this is probably the most confusing one. A misstatement of an item that has a value equal to or larger than the interval, then the misstatement difference between the book value and out of value is used, the actual amount. And these are not included in the rent allowance, which we haven't looked at yet. So let's go ahead and get started here. We'll go through these. The first four ones here are pretty straightforward. These are like we normally see. So the first three, I should say first three. The first three here are kind of what we're used to. You know, we do the ratio, audit, divide by book, times the interval, look at a projected value. equals 40,000. It's 28,000. Oops. Hey. And the projected misstatement is how much? What's the projected misstatement?
$12,000?
Yep. Good. All right. So our project misstatement is 12,000. Okay, so we do the same thing for the next one. We do the ratio 2,400 divided by that.
How does she get 1,200?
40,000 minus the 28,000 will give you 12. So this $40,000 interval, we're saying is really only worth 12, or sketch it. We're saying the $40,000 interval is really only worth 28,000. So we're saying that it's overstated by 12,000.
Okay.
Yeah. It's 32,000. 8. And this one's a little unusual. I'm going to talk about it a little bit, but generally though, if this is 0, 0 divided by anything is 0, and then this statement would be 40,000. I don't know if this is humorous or not, but they'll tell you in the books too, if it is 0, you have to look and see why, which is kind of funny because you're going to do that anyways. But if this is 0, then you have to see why that they have it on a 1700. But that's if the 0 is correct and the 1700 is correct, then this is it. And number 4 is unusual. What's unusual about number 4? Number 4 is different than 1, 2, and 3. Wow.
The amount of the book value is lower than the audit value.
Yep. This. Let me get blue, I guess. This is an understatement. I was going to mess up my spacing here, but this is an understatement. We ignore it. As an auditor, this this bugs me, but wait, it's wrong. No, it's not. Using this method, if you find it's not supposed to find those, and if it does, it says okay, everything's fine. You know, they're understating it by whatever, $700. So you don't do anything with this. There's no projected misstatement. Okay, down here, these last two, and these are probably the most confusing of them. And these kind of both fall in the same category, so we're going to work them out both the same, but you'll notice that the book value is higher than the interval. I should make them both green, but I'll do it anyways. You know, this is higher than the interval. Now, in one way, this is good because this means 100%, you're 100% sure that this is going to get picked. Right. So, you know, if the company thought that they were going to bump this account up to 44,000 to make themselves look better, they just made it 100% sure they're going to get caught doing it. But anyway, the book value is more than the interval. It's 100% sure it's going to get picked. Now, when it comes to the misstatement, though, this kind of poses a problem. The problem is, if we do this the same way we've been doing it, dividing it by this, it is going to understate our projected misstatement. Why? Because the actual misstatement is higher than the projected. This is, you know, how much is this actually off by? This is actually off by this is the actual misstatement here is 33,000 for that item. Just did something funny there. Okay, 33,000. If I were to multiply this out, 11 divided by 44 is one quarter. This would be 10,000. And this would be 30,000. Notice that this would understate what we know that this account is off by. We know that this is off by 33,000. So when we run into this situation where we have the book value is higher than the interval, we use the actual overstatement rather than the projected one. Why? Because the projected one's doing it over 40,000, where ours is going over a higher interval, basically, of 44,000. So this is what we're going to do when we run into these where they're higher. We use the actual difference. So whenever you have this situation where the book value is higher than the interval, you find the actual amount. And that's what you put in for your projected misstatement. Now this one down here is the same thing. This one's going to cover.
I got a question, Professor. So you are multiplying the 40,000 because you just minus the 44,000 from the 11,000.
You're actually not going to do anything with this interval.
Okay.
No, yeah. If you wanted to put the projected value, you could put 7,000 in there, I guess, if you wanted. You know, to make it come out to 40,000. But you really don't need to. You'll find that when we do these, we actually just look at the projected misstatement. Because like in this case, we had 20 items. You know, so what, 16 of those were fine. You know, 6 of them had problems. Actually, 5 of them had problems. This one really didn't have a problem. So it's not you look at the misstatements, projected misstatement. Okay, so see, we're going to do the same thing down here. And this one would cover at least 2 intervals, maybe 3. Ooh. Okay, I think I'm done being stupid now. I'll just go ahead and type it in. All right, so minus 65,000. Is it 25,000? So this is what we're going to put in for our misstatement. So we use the actual. When we run into this situation where we have the book value is higher than the interval, an unusual situation, but you know, it's one of the great things about this method though, is that we have that because that way, the more they cook the books, the more likely they are going to get caught. But when we do run into that situation, we use the actual, and the actual will be higher than the projected, because the projected is like over a smaller area. Projected is only over 40,000, this is over 44,000. Or down here, this is only over 40,000, which is this is over 90,000. All right, so we'd add all these up. 60. 118. I better use my You used to be good at it, man.
$118,000.
Yep. That's what I got. Oops. Oh, that isn't what I got. This is what I got. Okay, so the total book value was what, 800,000? So our total projected value for this would be, oh, what is that? Ah. $682,000. Okay, now incremental allowance. And this will make more sense when we look at this later. But the incremental allowance means that there could be more things wrong with a given interval than what we found. And the size of the error makes a difference. The larger the error, the more possibility there is that it could be off by a larger amount. So this incremental allowance kind of goes into the idea that, okay, the more things you have wrong, the more dollar amounts you have wrong, the more things might be off by. And if there's anything left in these intervals, there could be more things wrong. So these first three are all going to be included in what we call the incremental allowance. This one's not misstated at all, and it wouldn't matter anyways, even if it was, because it's 0. 0 times anything is 0. Now down here, though, these are going to be no's, and I'll tell you why. There's nothing left in the interval. these items cover the entire interval. There could not be anything more wrong with that interval than there already is found, because this is higher than the interval. So these up here, where the book value is less than the interval, these up here, they go into incremental allowance. Things could get worse. Things could be worse than what we're looking at. Down here, things could not get any worse. These cover the entire interval. There's nothing else in those intervals that could go wrong. Okay. Let's go to this last one here, and I'll put this all together, and we're not going to finish this handout. So that's a good thing. Have more weeks of fun with it. So we're going to put the whole thing together here. And by the way, this is pretty much exactly the way that the CPA exam, at least when I was going to, the way they would test it. It'd be in a problem like this. Okay, risk of incorrect acceptance. We'll talk about this later. Book value of accounts receivable, 6 million. And here we have our items. Audit value, book value, and the interval for all of them is 50,000. Oh, here's a question for you. How many items were in our sample? Hold on, I don't know myself. We have our interval of 50,000. So how many items were in our sample? Anyone? So we broke this $6 million up into $50,000 chunks, items. So how many do we have?
Was it 12?
I think it's 120.
120?
Yeah,
Okay.
Yeah, so we take
My math ain't math, and you're right. I forgot 0.
this is a 50. Yeah, so yeah, I think it's 120. It doesn't ask for that, but that's what it would be. So they had 120 items. They found these 3 that had problems. Okay, so audit value is less than the book. That's fine. It's less than the interval. Okay, so we're going to do this first one, is plain old. Oops.
I got 0.12. That's still 120 items.
6 million divided by 50,000.
$6 million. Okay, thank you.
This one is what, 40,000? All right, so we have projected value of 40,000, and projected misstatement is 10,000. That's an unhappy coincidence with that one. Oh, they're not the same. Okay, 1,600 divided by 4,000. Number 3 is unusual. What is unusual about?
It's an understatement. We just ignore it.
Yep. Accurate. Yeah, so this here, you'll see this is an understatement. This is more than that. Okay, we'll ignore the incremental allowance for now. But we will not ignore our projected misstatement, which is 10,000 plus 30,000. So what is that, 40? And by the way, this is our best estimate as far as what the book is off, what they're off by. So our best estimate is that this is off by 40,000. Now, it is a sample, so it could be off by more. So our best estimate is it's off by 40,000, but it could be off by more than that. Okay. We're going to have two different things come into play here. Hold on, I'm gonna switch cameras. I'll stop sharing because I don't like sharing any. And nope, I'm not gonna do that. I'm going to use the focus doggy. Thank you, focus doggy. All right. So it's sort of like this. This is not going to be to any kind of scale, but but it's sort of like this. The client says that the client says that their books are worth 6 million, right? So this is what the client was saying that their books are worth. We're saying that this is our best estimate is that this is off by 30,000. No, 40,000. So this is the projected misstatement. So here they say it's 600. Now this is a sample though. So it's possible that, at a certain level, I think this is at the 5% level. At the 5% level, it's possible that this is off by even more. It's not going to go the other way because we don't worry about understatements. It's only for overstatements. So this can only go down. So for those of you that has stats, this will be a one-tailed test. It could go down even further. And the two things that could drive it down even further, the first one is basic precision, which we'll talk about in a second. And the second one is incremental allowance. So those two things could are going to drive this down even further. So it's possible it's off by even more at the 5% level. And we'll see how we calculate this too. So we got this one, the 40,000 is our best estimate. We think that this is, that's our best estimate. Now we're going to see how far this could be off by. I apologize for my poor camera work. Oh, that's not what I want. Okay. So basic precision. And basic precision is a long way down here. All the way down to the very bottom. Basic precision. I'm going to copy this. I should have this up there. I don't know why I don't. Ah. All right. In the future, I'm going to fix this. So basic precision equals our interval times reliability factor. Okay. So our interval, we got that. That's this. Oops. Got to copy it. And we're going to multiply that by our reliability factor. Okay, reliability factor, we're going to use for basic precision, we use at 0 overstatements. We got to get them, this is at 5%. So at 5%, coming down here, 0 overstatements. We are going to multiply this by 3. And that will give us our basic precision. $150,000.
Professor, what made you choose 3 for the reliability factor? Like, I saw the 5%, but what made you choose 3?
On row 0, that is the factor at 5%. And yeah, well, no, but you asked.
Why do they choose 0? And I noticed they got all the other numbers. I know it says 0 right there.
Yeah,
right. That's my question.
Yeah, it's just the method. If you look at, I abbreviated this table to get it. Row 0 is used for the sample size, which we already did, and then this is basic precision. So they always use row 0.
Okay.
It's just part of the, and yeah, I should put that in there. It's hard to get everything to fit on one page. It's, there's a lot on here, and you know, like when I was taking it, this would have covered like 3 pages of the test book or something, but
Because it say the number of misstatements, so you would think you would be counting how many misstatements you have.
right. Well, but yeah, no, you're actually right, but that actually goes into what this basic precision is about, and which I haven't told you yet.
Oh, okay.
There's all kinds of things I haven't told, what is basic, but basic precision. Basic precision is if there were no misstatements, 0. If there's 0 misstatements, there's still a possibility this could be off because it's a sample. So let's say you did the whole, you did the whole sample, didn't find anything. It still could be off by some number. So basic precision says, okay, even if nothing is wrong that you find, this is a sample. You didn't take 100%. So because it's a sample, it could still be off by a certain amount, in this case, 150,000. So even if we didn't find any errors, this could still be misstated by 150,000. So the reason why there's 0 misstatements for the basic precision is that's the assumption that's made with basic precision, is that there aren't any, if there weren't any misstatements, how much could this still be off by? So that's what the basic precision is. So here, let me.
That makes sense.
And so that's what this is. So this would be 150,000, I think we just said. So, yeah. Oh, I guess you need another 0 in there, don't I? So this basic precision says, okay, if there were no errors at all, if you didn't find any errors at all, it could still be off by 150,000. So that's if there's no errors. Now over here is if we have errors or misstatements. If we have errors or misstatements, however you want to put it, that will go into what we call the incremental, saying, okay, if we find errors, things could be worse. And so that's where this incremental comes in. And this is going to be craziest thing you probably ever see in stats. I'm going to do the first one here just to kind of show you what. Let me get rid of all this. We go down to our reliability factor table. Let's make this. Make it green, I guess. And so what we do is we say, okay, there's overstatement 1 factor. Minus overstatement 0 factor. Oops. There's 1 factor, here's overstatement 0 factor. I was at 5%, sorry. Minus 1 will give us the incremental factor. I think it's 0.75. So 4.75 minus 3 minus 1 gives us this. And let's just do the incremental factors first, because these are the kind of wacky ones. The second one, overstatement 2. So this would be 630 minus Well, some number.
Is it 0.55?
And yes. You're faster than I am. So this would be the incremental factor for the second one. And the third one, you get the idea. For statement number 3. Uh, 0.46. Now, you may very well be asking yourself, like I have many times, why don't they just make a incremental factor table? It'd be easy to do using this table. To make an incremental factor table, you go, okay, look at the incremental factor table, but for whatever reason, they use the risk of incorrect acceptance, and then you kind of jump through these hoops to get to it. Okay, so we're going to look at the misstatements of above. And we use the largest one first. The largest misstatement is going to go in this first slot here. So let's go up to our misstatements. Oh, wait, right here. Went up too far. So which one is our largest?
The 30,000.
30, yep. So we're going to say, okay, look, this one is up by 30,000. So we're going to multiply that by the 0.75. That is 30,000.
So it's 22,500.
Yep. That again. So this is going to be our incremental allowance for that one. We're going to say, okay, look, it could be off by. This looks so funny. Get a little bigger. 22,500. So we use the largest one first. Second largest. 10,000. Oops, where am I at? Here we go.
And that one is 5,500.
17. Yep. Okay, now we don't have a third one. We really don't need. We need this one. I put the, this is 0. It'd be 0. 0 times anything. You really don't need this one here. But I don't know where I don't know if I put it in there. So anyway, so these two would be the total incremental allowance. So we're saying it could be off by as much as. I can put that in here. $22,500 plus. What is that? 28.
28.
So this is going to be our incremental allowance. So our best estimate that this is off by 40,000. Our basic precision says it could be off even if there were no errors at all. It could be off by 150,000. Our incremental allowance said, look, we found these errors. We found these errors, And because we found these errors, it's possible there are more errors out there. It's more likely that there are errors because we found these. And the size of the errors matter. You know, the bigger they are, the worse it could be. So we're saying that this could be up by another 28,000. So getting back to this thing, we I guess for incremental. We're saying that this could be off by another 28,000 because we found some errors. So this could be even worse than that. So our best estimate is that this is off by 40,000. You know, this is our best estimate. It's $40,000 shift, and then we said, okay, but it could also be at 5%, at the 5% level. Where's the green one? Here it is. You know, at the 5% level, it could be off as much as all three of these together. And so that's what this, the upper limit is on here. Okay, so that, oops, coming down here. I might do something here. Just to get more room. Okay, so we're going to take the projected misstatement, basic precision, and the incremental allowance. And I'm going to make a mess out of it. You can get a little more room up here. Okay. So these three together will be our total upper limit. So the upper limit on this is what? Two, no. Yeah. 218, you said?
Yeah, that's what I got.
Okay. Yeah, so this will be the upper limit. So this is how bad things could get at 5%. Oh. So, and this is what we would use to determine whether these were the, you know, of what it could be off by is 218,000. So our best estimate would be 40,000. This is our best estimate, what it's off by, but it could be off by as much as 218,000. This is the upper limit. And so this is what we'd use to see if they are materially missed for the material misstatement. All right. We're saying our best estimate is 40,000, but it could be off by as much as 218,000. And 218,000 compared to, I think this is, it should be 6 million. I got 600,000 here. This be 6 million. You know, is that material? You know, that's a judgment call, but we're saying that this is misstated. This $6 million account is misstated by 218,000, and we can now figure out whether that's material or not. Isn't that fun? Oh, come on, you guys. Let's do another one. We'll be here till midnight. Okay. All right. So let's stop here. We'll stop here. And next week we'll do the multiple choice and stuff for chapter 11, and we have left here. Is this one just one more? I tell you what, why don't you try giving this one a shot at home? I'll put the answer up next week, but try giving this one a shot. I know you probably don't want to do it now. Probably angry enough at it, but let's see. Number 6 is homework, and don't be afraid of making mistakes. I mean, if it happens, it happens. Okay. All right. Any questions? Oops, that's not me. There I am. Any questions? All right, nothing to turn in this week. Next week, I'll put the solution up to number 6, and we'll have that turned in next week, and then we'll also finish up chapter 11 and probably start in on chapter 12, which is inventory. All right, any questions? sorry for keeping you so late. All right, I'll see you guys in a week.
Thank you, Professor.
All right, thank you. Good night.
Good night.
Thank you. Good night.